Revlon is a cosmetics giant, or at least it used to be. Nowadays, Revlon's position as the market leader is crumbling, with the advent of TikTok stars starting their own cosmetic lines and more shoppers shunning brick-and-mortar retail for more modern online shopping experiences. The tide is shifting. New cosmetic upstarts like Fenty Beauty and Kylie Cosmetics are snapping up market share of newer, younger consumers and are carving out vast regions of the cosmetic market for themselves, leaving Revlon biting the dust. Revlon has failed to capture younger consumers. Most of its loyal customer base are older women. This is perhaps unsurprising since Revlon had their heyday in the 1950s and the 1970s. It dominated the cosmetics industry of the 20th century. At its peak, Revlon was the second largest cosmetics company by sales. Nowadays, while Revlon is still a large player in the industry, it ranks at the 22nd largest cosmetics company by sales. Revlon is an iconic brand. Today, while still recognized for its past achievements, it is less so. The company relies on a brick-and-mortar retail strategy at a time when malls are going empty and online strategies are more prominent. Revlon products are also more expensive than its competitors, Sephora and Ulta Beauty. These days, if you want your cosmetics business to thrive, you need to pay an army of TikTokers and Instagrammers to run ads for your brand. Revlon couldn't do that with no money and a debt to pay off. In 2020, when the pandemic hit, lockdowns turned the malls, salons, and spas into empty wastelands, destroying demand for Revlon cosmetics. After the pandemic ended, its sales started picking up, but they had too much debt and inflation was proving to be problematic for the company. Revlon's sales have improved after the pandemic reopening, but it has been dealing with problems with its suppliers. Revlon suppliers are now demanding cash up front and will not allow Revlon to ship goods on credit. Revlon also had to battle for raw materials to make their cosmetics. Ron Perelman, who owns 85% of Revlon shares, is known as the billionaire who always came to Revlon's rescue whenever the company's future looked bleak. He was always the one who kept Revlon alive through rescue loans or cash infusions, so investors had always believed that Mr. Perelman would always find a way to bail out the cosmetics giant. This time, Ron Perelman finally gave up on the company, and Revlon is finally on its last legs. Hedge funds were so desperate to recoup their investments in Revlon that they started Wall Street drama. A lot of investors who lent money to Revlon have lost hope of getting their money back from Revlon. The Wall Street drama involving Citi, Revlon, and the hedge funds proved this point. Back in 2020, Citibank did the unthinkable. The bank had accidentally paid off over $900 million of Revlon's debt using its own money, shocking everyone in Wall Street. This wasn't the first time Citi fucked up. Citi obviously tried to get its money back. However, the only ones who gave back the money were the Carlyle Group, KKR & Co., and Octagon Credit Investors, while most lenders, HPS Investment Partners, Symphony Asset Management, and Brigade Capital Management, chose to keep $500 million of the accidental payment. Citibank was enraged. Could you imagine being the guy who fucked up and gave the company's $900 million to a bunch of hedge funds? By accident? Not people, but hedge fund managers. The type of people who would never give you your money back. Someone in Citibank lost their job that day. Citibank's top salesman, McLaughlin, went to Brigade Capital's holiday party at a restaurant overlooking Manhattan's Central Park and threatened to sue anyone who didn't give Citibank's money back. Hedge fund managers at Brigade told Citibank they would give Citibank its money back as long as the bank promised to forfeit all funds if Citibank lost in court. Citibank refused. What hedge funds were basically saying was, hey Citibank, we'll give you the money back as long as you give us back the money once we win the lawsuit. So both an enraged Citibank and hedge funds went to court. The hedge funds' main defense in the courts was that they had no reason to believe that the $900 million in transactions were made in error until Citi claimed it as such and demanded repayment. Witnesses from the hedge fund side testified they had never seen a similar error where a bank had paid lenders the exact amount of principal and accrued interest under a loan in error, while Citibank fought back by showing emails and proof of communications where lenders had used the words unbelievable, erroneous, accidental, and overpayment as words when discussing the city's $900 million mistake. Surprisingly, against all odds, the judge sided with the hedge funds and allowed them to keep their money, but froze funds until further litigation ended. Citibank was furious when they heard the court's verdict and made an appeal right away. Both sides are still battling for the money till this day. The reason these hedge funds have kept the money Citibank sent them by mistake was not just because they were greedy hedge fund managers. No, hedge funds like Brigade Capital and HSP Investment Partners held a grudge with Citibank because of how the bank handled Revlon's debt. Lenders of Revlon's debt had been angry with Citi for a while now for helping Revlon restructure its debt in ways that would have destroyed the value of their investment and lower the hedge fund's chances of being repaid in full. All this just proves how desperate Revlon's lenders truly are. No one believes they will be able to recoup the loans they handed out to Revlon. Even before the pandemic, there were signs of Revlon's imminent collapse. Revlon had been losing money for years. Revlon's revenue has consistently hovered around the $2 billion range across the past 4 years. However, the revenue does not equate to profit. If we take a look at Revlon's net profit after all expenses, they are actually losing money. In 2018, Revlon lost $290 million. In 2019, it lost $157 million. In 2020, at the height of the pandemic lockdown, Revlon's losses ballooned to $619 million. And in 2021, the money Revlon lost, while still lower, still reached $206 million. To make things worse, Revlon's consistent revenue of $2 billion annually for the past 4 years implies stagnant growth, especially in the stock market when investors expected annual revenues to grow by an average of 10 to 30% per year. On June 13th, Revlon's stock price bottomed out when there were rumors of a potential bankruptcy filing. The stock actually dropped to $1.17. This was a fall from $4 in the beginning of June down to $1. Revlon's worth became a quarter of its previous value. Its earnings per share are in the negative numbers, negative $3.20. If you look at what Revlon started at the beginning of the year, which was $11, you see the drop to $1 means the value was divided by 11 times. This is unsurprising since Revlon has had debt problems for years, and 2 days later on June 15th, Revlon filed for bankruptcy, proving the rumors right. Despite this, Revlon's stock doubled when the news hit, going from $1 to $2. But wait, why did the company's bankruptcy push Revlon's stock up? It's losing money. It owes a ton of money to people. So why would anyone want to hold on to such a bad investment? There are two groups of people trading Revlon stock right now. Institutional investors shorting the stock and retail investors piling into the stock. According to Fintel's data a few weeks ago, 37% of Revlon shares are tied up in short positions. These investors want the stock to drop so they can profit. They're basically banking on Revlon stock going to zero because of the company's bankruptcy proceedings. Tons of retail investors believe there will be a short squeeze on the horizon. There are many ways the stock can go up. Traditionally, if a company can meet analyst estimates by beating it, making more money per share than originally predicted, then the shares go up. Shares have a tendency to go up over time as the company's profits go up. This is a slow and steady process that could take months to years, but there are other ways where a share can go up drastically within mere weeks to months. The other way I mentioned is a short squeeze. If a stock is heavily shorted, there's a chance that there will be a quick spike in the prices if short sellers are wrong with their predictions, and if the stock goes up, the short sellers will be forced to close their positions, raising the share prices. This is called a short squeeze. Meanwhile, as institutional investors are panicking and Revlon's share prices shoot up higher and higher, Wall Street bets degenerates who have positions in the stock can cash out. Two ingredients necessary for a short squeeze are a fuck ton of short interest and a low market cap. If any stock has these characteristics, then it has the recipe for a short squeeze. Looking at Revlon, it has a market cap of around $250 million. That is low. The market cap is the amount of money people have placed in a certain stock. Small cap companies have a market cap of around $300 million to $2 billion, while middle cap companies have a market cap of around $2 to $10 billion. Revlon is a small cap company because its stock is worth only around $250 million in total. In terms of short interest, over 60% of Revlon's publicly available stock was shorted. This means the short interest is ridiculously high, so the amount of shares that the institutional short sellers will be forced to buy to cover their positions when Revlon's stock goes up will be astronomical. So while institutional investors are trying to short Revlon to the ground because of its bankruptcy risks, the retail investors think otherwise. To them, all the short interest in Revlon is another catalyst for another short squeeze. It was a chance to get in fast and get rich quick when the stock shot up. But in order to do that, buying pressure on the stock had to be massive, so retail investors piled into the stock in droves. So understandably, there has been a spike in the over-the-counter call option volumes for Revlon stock in the past few months, mostly fueled by retail investors. When the news of a potential Revlon buyout hit, things got crazier. Retail investors were more optimistic of the chances, and Revlon shares shot up to $8.14 on June 22nd, bringing Revlon up by 800% from its all-time low of $1.17 in June 14th. Revlon's trading volume was spiking. 7 times more shares were changing hands every single day. If you were trading using Fidelity's websites, you would have noticed that Revlon was the second most actively traded stock, just below the number one stock, Tesla. Tons of retail investors are piling into Revlon stock. So how horrible is the bankruptcy? Revlon's debt is trading at horrifically low levels. Corporate bonds are not public. However, financial regulators have created a trade reporting and compliance engine called Trace, which provides a helpful window into an otherwise opaque bond market. According to Trace, which collects data on corporate bond trading in the over-the-counter markets, over $450 million of debt bonds coming due in 2024 was changing hands at 10 cents on the dollar, showing investors don't believe in Revlon's ability to recover from the bankruptcy. While Chapter 11 bankruptcy still allows Revlon to continue operating its stores, Revlon had the borrow money to keep its stores open. The company has so far managed to line up $575 million through bankruptcy financing from its lenders to pay for court proceedings and to fund Revlon's cosmetic operations. This isn't the first time Revlon has tried to avoid collapsing. In 2020, Revlon was on the verge of bankruptcy. Ron Perelman would have lost all of his 80% worth of Revlon's shares if the company weren't under, so he made a lot of effort to avoid this. Ron Perelman tried salvaging the company using a bond exchange offer, where owners of Revlon's debt could swap their current debt for new debt. Perelman had trouble getting Mr. Carl Icahn participate in the bond exchange offer. However, Perelman got lucky when Carl Icahn had a change in heart after he saw most shareholders had participated in the offer, so Revlon managed to avoid going bankrupt in 2020. So does Revlon have the potential to become a meme stock? Yes, it does, and here's why. Not only does it have a ton of short interest and a low market cap, the wonderful degenerates on Wall Street bets believe Revlon is another Hertz play. The main reason Revlon stock rose after its bankruptcy is because of a potential buyout. People believe as long as a large company swoops in and buys out Revlon at a price larger than what it's worth, then the stock will be worth much more. Many are hoping that Revlon's stock situation will play out like Hertz. The Hertz company is a car rental company, and like Revlon, they had filed for Chapter 11 bankruptcy because they couldn't repay $400 million to their lenders. It was May 2020 and Hertz stock dropped to 40 cents on the dollar after their bankruptcy announcement. However, within a week, Hertz stock rebounded. Hertz had shot up to a high of $3.70, an entire 800% increase. So why did this happen? Hertz is actually a car company. It makes money by renting out cars to people. It's been in business for a century now, and if you ever rented a car at an airport, it was probably a black and yellow Hertz car. When the pandemic hit in 2020, everyone was confined indoors and no one was traveling, so Hertz car business was drying up. Used car prices were dropping and they were running out of money, forcing them to declare bankruptcy. Then a year later, after the bankruptcy announcement, a group of investors, including Knighthead Capital, Apollo Capital, and Soteres Opportunities swooped in to buy Hertz for $6 billion. This deal gave all shareholders $7 to $8 a share, which was more than what retail investors had spent on their Hertz shares. The pandemic reopening had created a pent-up demand for travel. There was a shortage of rental cars since many companies had sold their used cars in the pandemic. All these factors drove optimism and demand for Hertz rental cars. Revlon stock popped off after a news agency in India called ET reported there were rumors about a potential Revlon buyout by one of India's largest companies, Reliance Industries. You might know Reliance as the giant megacorpo, which is owned by India's richest man, Mukesh Ambani. The rumors might have some grounds. Reliance Industries have been trying to diversify its portfolio of companies away from oil and gas, so entering the cosmetics industry by purchasing a company with a history of excellence and turning it around might be a smart move. Reliance so far has refused to comment on whether the buyout rumors are genuine. To complete a buyout, Reliance would have to foot Revlon's debt bill and buy the majority of Revlon's shares from Ron Perelman, who owns 85% of the shares. Retail investors win if a company buys out the cosmetics company, while short sellers lose. So should you buy the stock in the end? Revlon is currently carrying out reorganization bankruptcy to shuffle its debt around. The aim is to write off their debts and continue operating after all this is done. The fear is the company's stock could lose all its value because Revlon's lenders will get priority payouts first before retail investors. That's not the only concern. When companies emerge from bankruptcy, old shares are often cancelled and only the new shares will have any value. Revlon has also begun its delisting process already, so retail investors of Revlon could see their positions go to zero if they're not careful. As always, none of this is financial advice. Like and subscribe.